XEQT sounds almost too simple. One ETF, thousands of stocks, global diversification, automatic rebalancing. But can one ETF really be your whole portfolio? That is the big question we are answering today. Is XEQT a smart one-ticket investment, or is it too simple for beginners? Welcome back to Investing with Pankaj, where we make personal finance and investing simple for Canadian beginners. Today, we are breaking down XEQT, one of the most talked about all-in-one ETFs in Canada. First, what is XEQT? XEQT stands for the iShares Core Equity ETF Portfolio. It is an exchange-traded fund from iShares by BlackRock Canada. Simple version, it is a fund that holds other ETFs inside it, and those ETFs hold thousands of stocks. So when someone buys XEQT, they are not buying one company. They are buying a basket that gives exposure to many companies across different countries and markets. BlackRock says XEQT seeks long-term capital growth by investing mainly in ETFs that provide exposure to equity securities. In normal human words, XEQT is built for long-term stock market growth, not short-term cash safety. The most important thing to understand is this: XEQT targets 100% equity. That means it is basically a full stock portfolio. It does not have a normal bond cushion like balanced ETFs do. That can be good for long-term growth, but it also means bigger ups and downs. If the stock market falls, XEQT can fall too. This is where beginners sometimes get confused. They hear diversified ETF and think safe. But diversified does not mean risk-free. It means your risk is spread across many companies and markets. As of July 29, 2026, BlackRock listed XEQT with 8,378 underlying holdings. That is one of the big benefits. Instead of trying to pick a few winning stocks, XEQT spreads your money across thousands of companies. But here is the twist: thousands of stocks does not mean zero risk. If global stock markets are having a bad year, a 100% equity ETF can still have a painful year. BlackRock's own return table shows this clearly. XEQT had positive calendar year returns in 2021, 2023, 2024, and 2025, but in 2022 it was down 10.93%. That is a real reminder that even simple ETFs can drop. Now let's talk about what is inside XEQT. XEQT is a fund of funds, which means it holds a small number of underlying ETFs. These underlying ETFs give exposure to Canadian stocks, US stocks, developed international stocks, and emerging market stocks. That is why people call it an all-in-one ETF. Instead of buying separate ETFs for Canada, the US, international developed markets, and emerging markets, XEQT packages everything into one ticker. This is helpful because building your own portfolio can get messy. You may need to choose multiple ETFs, decide percentages, rebalance them, and avoid changing your plan every time the market gets noisy. XEQT tries to simplify that by doing the allocation and rebalancing inside the fund. BlackRock says its asset allocation ETFs are continually monitored and rebalanced as needed to maintain target weights. For a beginner, that simplicity can be powerful. One ticker can reduce decision fatigue. No constant guessing. No building a complicated spreadsheet. No asking, should I buy more Canada, more US, more international, or more emerging markets this month? But simplicity also has a cost. You accept the fund's design. You do not control the exact country mix. You do not control the exact sector mix. You do not pick which companies go in and out. So the question is not, is XEQT perfect? No ETF is perfect. The better question is, does XEQT's design match my goals, timeline, and risk tolerance? Let's talk about fees. As of July 29, 2026, BlackRock listed XEQT's management fee at 0.17% and MER at 0.2%. MER means management expense ratio. Simple version, it is the yearly fund cost built into the ETF. A 0.2% MER means about $2 per year for every $1,000 invested, before any trading commissions or platform costs. Compared with many traditional mutual funds, that is low, but it is still a fee. Now, could you build something similar yourself with separate ETFs and maybe reduce the fee slightly? Possibly. But then you also take on more work, rebalancing, tracking weights, dealing with more moving parts, and maybe making emotional mistakes. For many beginners, the biggest problem is not whether they can save a tiny amount on fees. The bigger problem is whether they can stay consistent and avoid constantly changing strategy. That is why XEQT can be attractive. It is simple enough that a beginner can understand the basic idea: buy one globally diversified, 100% equity ETF and hold it for long-term growth. But here comes the hidden risk: XEQT is not for every timeline. If someone needs their money in 1 year, 2 years, or even 3 years, a 100% stock ETF may be too risky because the market can drop right when they need the cash. For short-term goals, like next year's tuition, a house down payment soon, or emergency money, XEQT may not be the right tool. Cash, high-interest savings, GICs, or safer options may fit better depending on the goal. XEQT is more suited to money you can leave invested for the long term. That could be retirement savings, long-term TFSA investing, RRSP growth, or other goals where you have time to ride out market drops. Now let's compare XEQT with balanced all-in-one ETFs. XEQT is 100% stocks. XGRO is more growth-focused with some bonds. XBAL is more balanced with more bonds. So the right choice depends on how much volatility you can handle. If your investment drops 20% and you panic sell, then the problem may not be XEQT. The problem may be that your portfolio is too aggressive for your emotions. That is why risk tolerance matters. A good investment on paper can become a bad investment if you cannot actually hold it during market stress. Beginner mistake number 1: thinking XEQT means guaranteed wealth. It does not. It is still exposed to stock market risk. Beginner mistake number 2: buying XEQT for short-term money. A 100% equity ETF should not be treated like a savings account. Beginner mistake number 3: adding random extra ETFs without knowing why. Some investors buy XEQT, then add more US ETFs, more Canadian ETFs, more tech ETFs, and suddenly their simple portfolio becomes messy again. That does not mean you can never add anything else. It means you should understand why you are adding it. Are you improving your portfolio, or are you just chasing recent performance? Beginner mistake number 4: checking the price every day. If XEQT is part of a long-term plan, daily price movement can create unnecessary stress and bad decisions. So who might XEQT fit? It may fit an investor who wants a simple, long-term, globally diversified, 100% equity portfolio and can handle market volatility. Who might it not fit? It may not fit someone with a short time horizon, low risk tolerance, need for stable income, or someone who gets nervous when investments drop. Here is a simple way to think about it. XEQT is like a global stock market basket. It gives you many stocks in one package, but the entire basket can still go up and down. The strength is simplicity and diversification. The weakness is that it is still 100% stocks, and it may feel painful during market downturns. So, is XEQT one ETF portfolio or too simple? For the right long-term investor, it can be a clean one-ticket solution. For the wrong investor, it can be too aggressive. The lesson is not, everyone should buy XEQT. The lesson is, understand what it is before you buy it. Before buying any ETF, ask 4 questions. What does it hold? What is the fee? What is the risk? And does it match my goal and timeline? Simple lesson: XEQT can make investing easier, but it does not remove risk, replace research, or guarantee returns. Do your own research and comment your thoughts. Would you rather use one all-in-one ETF, build your own ETF mix, or pick individual stocks? Follow Investing with Pankaj for simple Canadian money lessons. Educational only. Not financial advice.